Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, March 21st, 2023. Welcome back to the podcast, George.
Great to be on, John.
Always good to have you, and particularly good to have you when there's so much to talk about. I would argue there's so much to catch up on since our last episode. I really don't know where to start. We have gone from a world fearing 6% terminal funds after that pretty hawkish showing by Fed Chair Powell in his semi-annual testimony to Congress, to just days later, markets experience a crisis of confidence in the banking system following the well-publicized failure of a couple of U.S. regional banks, as well as the forced merger of a GSIB in Switzerland. So in many ways, you've been saying this is how it ends, that the Fed would hike until, and I quote, something breaks in the markets, the economy, or both. You recently published a report on liquidity and how we got where we are. Why don't you summarize the current environment and how you think about bank liquidity here, citing some of the stuff you put together in that piece?
Yeah, no, John, it's actually always going to be hard to kind of summarize what's been a developing story since really last year. And you can even go even a step further than that with what we've kind of characterized as the have and have-nots within the banking system and the access to liquidity, or just where deposits migrate over time. But taking kind of a step back and looking at how we got here, as part of these massive kind of QE programs and fiscal stimulus coming out of the pandemic, there was just a lot of a deposit surge within the system, which disproportionately hit some banks more than others, depending on what was going on throughout the regional parts of the economy, and that left some banks with a lot more cash than what they knew what to do with, and that also then would translate into bond purchases at a time where rates were at historical lows, given that we had just gone through the pandemic. And so, there's going to be a lot of kind of Monday morning quarterbacking, going back and trying to figure out how we got here. But I think one can make the argument that it's not just the hikes themselves, but also the easing cycle that existed prior to this massive hiking campaign that really sowed the seeds for what we're going through right now. And that's literally a classic case of asset liability management, the availability of liquidity, and again, some of the larger versus smaller banks, the dispersion on where liquidity resides, and the different business models and how they invest their deposits. So I think all of that is kind of what we got here. We touch upon this in the piece. We are kind of surprised that this is again part of what happens when there is tightening by a central bank. It does raise rates, and that should lower bond prices. As long as bond math is still working the way it used to, and I think this is just really in the works. We've been noticing for quite some time. This is all public record information that there was an increase in home loan bank liquidity usages through their advances program at a time where you always heard people saying, "Oh, there's so much excess liquidity in the system." But again, it was the have and have-nots. The actual depositors as well as investors in general start to shift their behavior around where they park their cash as well during this rise in rates. The advent of the Fed's reverse repo program, which is something we've also been, discussing for many, many podcasts over the last year and a half, that really absorbed a lot of the liquidity, kind of like QT on demand, but it took money out of the banking system, exposing the haves and have-nots throughout the system. And so it's this was ultimately going to happen. It was just a matter of timing around how this would all work out. And since then, we've seen a pretty forceful reaction from both the Treasury, FDIC, and the Fed at trying to address the liquidity needs of the system. The fact that it was codified in the statement that if shareholders and bondholders of banks go to zero, that's part of the design of how they're going to handle these sort of situations going forward post 2008. The fact that that was in there really stresses the idea that they're focused on being the lender of last resort, the historical traditional role of what a central bank is to provide liquidity against good collateral at a punitive rate. I don't think this is the Fed trying to ease per se, but in the week, in the last week alone, and we'll see what happens in the coming week when we get the new balance sheet update. But the Fed balance sheet grew by 300 billion. Its new program, the BTFP, was put in place. These FDIC bridge banks that were taken over also access liquidity. So, we're in a much more state of flux when it comes to the banks. There's been a lot of bank volatility in terms of the stock market. There's been, again, deposit migration to large banks and to money funds, which saw over $100 billion of deposit growth, and then massive usage of the home loan bank advances. There's a lot going on here, and it does kind of signal that that the banks are hunkering down here. And at a minimum, it's defensive. At the worst case, something larger is at play, and I think that it does argue for a much more cautious environment. And again, all these things are discussed in our piece. At this point, we think it's too soon to extrapolate what looks like idiosyncratic risks among a few number of banks to suggest there's a much bigger problem, but you just don't know. And I think that at this point, kind of taking a wait and see is probably the best approach at this point.
Yeah, I think hard to argue that some caution isn't warranted. As you said, you knew something was going to happen. You just wasn't sure where it was going to show up. Arguably crypto was first. Bond market, losses, obviously up there. The problem seemed to have bubbled up among U.S. regional banks as well as some banks internationally. Question is what's next. But given that we're sitting here one day before the all-important before the conclusion of the March FOMC meeting, we would be remiss to not cover the FOMC. The probability of the Fed hiking has certainly improved over the last couple of days as risk sentiment has stabilized. But I would argue that the question of if they hike or if they hold is still very open. In our conversations, I know you share the same feelings on that. Let's explore some of these scenarios that you've laid out in your recent FOMC preview piece. Talk us through it. Talk our listeners through the Fed's options and how you think things go down.
Sure. And just for the record, before the turmoil that we've seen in the banking sector and the concerns thereof, we were of the view that there was a couple more hikes left in the Fed, that this would have been a 25 bip hike. Dots would have slightly gone up if we had not seen the level of volatility that we just went through. We've had multiple standard deviation moves in the 2-year note, a range within a 1-month window that we've never seen historically back until the 1980s, 70s, where rates were much higher. So the amplitude was easier to swing 100 basis points. But when you're swinging from 4 to 5 or from 5 down to into the mid threes, I mean, that's a lot of volatility in a very short time period, which, has led to, again, markets being much more defensive and concerned about what that does for the outlook. Financial conditions has had equally large swings, the curve as well. Spreads have widened largely because they've been unable to keep up with the big moves in rates, but they haven't really come back yet either, even as rates stabilize here. And so this is the most unusual kind of backdrop going into a Fed meeting where ostensibly we're probably closer to the end of the hiking cycle because we were already thinking that to begin with. Our view was, again, a couple more hikes, and the data was going to start to turn weaker into Q2, Q3, and eventually at some point that would arrest further Fed hikes, and that would then take care of the inflation problem. At this point, it's a really close call. We have a pause of a kind of a what we call it like a hawkish pause, where we think that they can spell out why it's prudent to take a wait and see at this meeting, considering everything that was just rolled out, and considering that there's still concerns about deposit migration from the small banks to the large banks, and and adding another rate hike in the midst of this when that is kind of what got some of the people concerned about bond losses to begin with. Does that make sense? But then you can easily make the case on the other side where the ECB last week hiked. Showing a vote of confidence by hiking means that they don't know something that we don't know, and hiking also would at least not encourage those looking for cuts to add to even further cuts. And so like the arguments can be made in both sides. And so I think it's a much closer call of a 50-50, to be honest, between a hike and a no hike. And the markets are pricing closer to 80% as we go into, I think, tomorrow's meeting. I think that the risk reward is probably to be more defensive because they could skip. Now, if they do hike, I don't think the market's going to move that much because they've the rates markets have at least backed up in rates and have at least given them the opportunity to do so. But if they hike tomorrow, and if it's not hiking with conviction and signaling that there's more hikes to come, i.e., if they don't raise the dots and if they don't, and if Chair Powell during the press conference does not come out and say that we can handle both inflation and this financial stability risk that's out there, this kind of balance of risk exercise. If he has a hard time explaining that, and it comes across like they're moving toward data dependency, the market might view that as that tomorrow being the last hike as well, and then that might usher in other reactions too. So I think it's a really super close call. I've never seen it this close, I think, in my career, and this is what you would expect after the fastest hiking cycle. Again, coming up on a 1-year anniversary of that start of last year, after being in an easing mode and calling inflation transitory. The Fed's had a really difficult job in the last 2-3 years. So I think it's going to be a close one for tomorrow. Either way, I do think that they're closer to being done. I think the data is going to start weakening here, and the sort of tightening that's happened both within banks and banks relative to each other, and just lending standards are probably going to be tightened. There's going to be less appetite to offer lending throughout the economy. I think that what we just went through probably does pull forward the recession anyhow, and so that might do a lot of the Fed tightening to begin with. So I think we're very close to them being done. If it's not tomorrow, it's at the May meeting, and then we'll take it from there. But yeah, it's going to be fascinating to watch, and it's going to be really more about the signal between 2:00, 2:30, if they do hike or don't hike, and then how does Chair Powell handle everything during the press conference.
Whoa, I do not want to be Chair Powell right now.
I hear
But
you.
yeah, but as you say, kind of coin toss here. You've got a 50% probability for a hawkish pause, a 45% probability for a dovish hike, and a 5% probability for a hawkish hike. Seems about right for me. But clearly the FOMC is close to being done regardless. So for more, I would definitely encourage our listeners to review some of your recent U.S. macro strategy pieces. Some of your recent U.S. macro strategy pieces, specifically liquidity everywhere, but not a drop to drink, as well as the March 2023 FOMC preview and market implications piece. Cover a lot of the stuff we discussed today and more, plus a ton of really amazing charts to go along with it. And again, if you are not receiving George's strategy reports directly, please do get in contact with him. Great stuff as always, George. Thanks again.
Thanks, John. Good luck, everybody.
Yeah, I think we need it. And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for further information. Check back soon for more insights from the Global Markets Research Team.